Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Europe podcast. Good morning. It's Tuesday, the 18th of November. I'm Caroline Hepker in London.
And I'm Stephen Carroll in Brussels. Coming up today, a global sell-off in stocks deepens and fears of a market correction grow ahead of earnings from the world's most valuable company, Nvidia.
Bloomberg Economics finds little evidence that artificial intelligence will deliver the growth needed to support sky-high valuations.
Plus, how the rich stay rich. An inside look at how wealthy British families are overhauling their fortunes while bracing for the next tax hit.
Let's start with a roundup of our top stories.
US and European equity futures have dropped as the markets join an accelerating sell-off across Asian stocks. In Japan, the Nikkei 225 is down by almost 3%. S&P E-mini futures on Wall Street are down by 0.5%, and Euro Stoxx 50 futures are 1.2% lower. The moves underscore a broader flight to safety as traders position for heightened volatility. Headlines on China-Japan tensions, Fed rate uncertainty, and earnings from the world's most valuable company, Nvidia, are all driving negative market sentiment. Lian Ting Tu is managing editor for Asian equities at Bloomberg.
There's a lot of uncertainties out there. As you guys talking about Fed, that's the biggest thing, right? Nvidia, yes, it's a big event, but people immediately look ahead to the Fed decisions, right? And also all these eco data from the US that's been delayed. We don't know how the picture will be. So altogether, I think, although December, historically speaking, is a positive month, overall, I think this December may be a bit cautious.
Bloomberg's Lian Ting Tu speaking there as alarm bells ring for analysts who study chart patterns in the US stock market, fueling concern that the latest dip could swell into a full-blown correction of at least 10%.
Bitcoin has dropped below $90,000 in Asia trading as the token's deepening slide has erased all of its 2025 gains. After topping $126,000 in early October, the cryptocurrency's decline has been dramatic as renewed concerns over stretched valuations hit the digital asset. Ana Herrera is Bloomberg's senior crypto editor.
I guess we're going to see if there are more liquidations out of crypto ETFs, because that was a big change. When the ETFs were approved, we saw a massive inflow from retail investors, and now it's not coming back. They're pulling out. I guess maybe people are becoming more sensitive and used to the big price swings, and they don't want to risk it again. And it's maybe following the wider sort of risk-off environment.
Bloomberg's Ana Herrera speaking there as options traders bet on deeper losses with demand for downside protection at the $85,000 and $80,000 levels dominating recent flows.
Bloomberg Economics have been looking into the question of whether AI will deliver on its promised returns by using a framework from Nobel Prize winner and MIT economist Daron Acemoglu. Bloomberg's Ewan Potts has more.
It's perhaps the biggest question currently on investors' minds. Will the hundreds of billions of dollars being invested in AI actually pay off? The analysis by Bloomberg Economics starts with the idea that AI doesn't replace entire jobs, but rather particular tasks within them. They say using conservative estimates implies a boost to US GDP of more than 1% over 10 years. That's the equivalent of about 0.1 percentage points on annual growth. Using a more optimistic scenario from the same model gets to a GDP increase of nearly 7%, or about 0.7 percentage points onto annual growth. Bloomberg Economics concludes that some AI investors might be in for a big payday, but that doesn't mean AI is going to make everyone better off. In London, I'm Ewan Potts, Bloomberg Radio.
President Trump says that he will allow the US to sell F-35 fighter jets to Saudi Arabia. The highly advanced stealth planes are a prize long cherished by Crown Prince Mohammed bin Salman, who is visiting the White House today. However, the sale of the jets requires congressional approval and years of negotiations. Barbara Leaf, former US Assistant Secretary of State for Near Eastern Affairs, says Israel currently has a monopoly on F-35s in the Middle East and could raise legal objections.
There is the issue of not just U.S. policy, but U.S. law, which is that the U.S. will uphold Israel's qualitative military edge. And so there's quite a bit of careful scrutiny and analysis that goes into such a decision so that Israel's QME is upheld. And we've heard from Israelis that they had hoped that there would be a good bit of conditioning on that.
Barbara Leaf speaking there, as Bloomberg understands that President Trump could be trying to lure Saudi Arabia into establishing diplomatic ties with Israel.
The UK is drawing up measures to retaliate against the European Union's plans to hike steel tariffs to 50%. Britain's metals industry has warned the levies could result in the biggest crisis in its history. Bloomberg's Freddie Fulston has more.
Britain's once mighty steelmakers were pioneers of the 19th century, and now what little of their production remains risks being wiped out. The UK has been swept up in the EU's efforts to protect its own steel industry. That's why the government is looking to tighten import quotas and accelerate the replacement of its own safeguards. The steel industry says the government has to act, but countermeasures would raise more questions than answers about Starmer's efforts to rebuild the UK's relationship with Brussels. In London, Freddie Fulston, Bloomberg Radio.
German Chancellor Friedrich Merz says the EU's banking regulations are too strict. He told an audience of financial professionals in Frankfurt yesterday that the US gives lenders an easier ride to free up financing for the economy.
The regulation of banks is also important, ladies and gentlemen. In Germany and in Europe, I want to say this very clearly. It is too strict. After the financial crisis of 2008-2009, we made many decisions that were right and remain right. The risk buffers have become larger. The reserves have become stronger. All of this is correct. But what we are currently seeing in America and in other parts of the world, also in other parts of Europe, provides far more opportunities for corporate financing than, for example, in Germany.
Friedrich Merz speaking there. His remarks join a chorus of European politicians calling for looser regulations to bolster investments into defence and digital technology. According to Merz, Germany will implement the EU's Basel III standards in a targeted manner without adding extra requirements in order to reduce the burden on its banks.
And the UK's cap on bank deposit insurance will go up next month. The Prudential Regulation Authority will lift the amount of customer savings protected in the event of institutional failure to £120,000. That's more than was floated earlier in the year. Although the guarantee trails the US, the planned change puts the UK's financial services compensation scheme ahead of the EU, where the limit is €100,000, or just above £88,000.
And those are our top stories for you this morning. In a moment, we're going to bring you more on the market sell-off, plus also how Britain's rich are preparing for next week's budget from the Chancellor Rachel Reeves. But before we get into those stories, something else we've been reading about today, and this is all about Jeff Bezos.
Yeah, indeed. So Bloomberg's Joe Constance has been writing about how Bezos is back in an executive role for the first time since he left Amazon in 2021. He's now running a 100-person company where ultra-lean teams are the name of the game. It's an AI startup called Project Prometheus. Joe's been writing about how Jeff may be bringing some of his management strategies that he honed at Amazon, things like writing memos. He doesn't want slide decks when it comes to presenting things. He wants a maximum 6-page memo, and you bring it to a meeting and everyone reads it in silence before the meeting starts. So that means that people know they have to give you lots of information and they know that everyone else will read it.
Wow, you have to read it whilst sitting in the room. That's interesting, isn't it? So not short meetings. And he's also got another one, which apparently is a pizza rule. 2 pizza rule. A team should be small enough that they can be fed by a couple of pizzas. I suppose it depends how hungry your team is, surely.
Well, indeed. But I think it's something to think about as Jeff Bezos is transitioning from running a massive company, Amazon, to a much smaller one as well. And also, you know, companies that he built at very different times, and with the focus now on, you know, really, especially in the AI game, you know, talent is the name of the game, and you have to have, you know, each team member really needs to count, but potentially be handled in a very different way than the way you'd manage massive teams.
Yeah, I love it. I really like Joe's reporting. But of course, it slightly dodged the fashion question, because the other big thing that Jeff Bezos and Lauren Sanchez Bezos have been, known for now, or are going to become known for, is that they're sponsoring Anna Wintour's 2026 Met Gala. Costume art, apparently, is the theme. They featured also because they got married in Venice in that lavish event. Lauren Sanchez Bezos was featured on the front of US Vogue. Anyway, so there you go. Lots of different ventures that the Bezoses are into at the moment.
Well, let's turn back to our top story this morning, and the sell-off now deepening across markets. Equities in the red in Asia, futures in Europe and in the US pointing to further losses later. Our Markets Live executive editor Mark Cudmore joins us now for more. Mark, good morning. What is driving the sell-off today then?
I don't think there's any really fresh catalyst. I think this is the theme we've kind of had for the last couple of weeks, that we're getting a bit of a correction in the meme stock, momentum stocks, AI theme. A correction we've not seen in this whole cycle up. I mean, the bull market since April, it's been remarkable for how little volatility we've seen. And to be honest, this pullback still is not very large. We've talked a bit on the show in the last couple of weeks when I've come on with you about it. Even the move sell started at the end of October. It didn't look like it was exhausted. I think we're probably getting closer to that exhaustion point in the short term. This isn't the bubble bursting. We are in an AI bubble, an AI capex bubble, and it will end really nastily someday. This isn't the bubble bursting. This is just the first dose of volatility we're getting, and it's not even very particularly panicky volatility. So I don't think there's really a fresh catalyst. I think that the main driver here is that the crypto space is getting destroyed, and that's got much more downside. We've talked about it before. Digital asset treasury companies just are going to continue to putting pressure on the sector. So generally crypto will have a lot more to weaken, and that weighs on sentiment. It weighs on the retail sector in particular, which is why they stop buying their favorite kind of big tech names, which is why you're seeing that kind of tech names suffer the most, and you're seeing a little bit of rotation in the market as a result. So value names hold up a little bit better than those retail favourites in the tech space.
That's interesting. So then, in terms of the kind of analysts and why they're concerned, I mean, you've said you don't think this is kind of limited volatility. What are the next catalysts? Are Nvidia's results or other catalysts coming?
So Nvidia's obviously the big one. So the whole world is driven by AI and the AI theme. That dominates everything in markets at the moment until that bubble blows up at some point next year. And Nvidia earnings, look, it is the king of the Nvidia trade. And it's really important. It's both the biggest company in the world. It's added the most market cap, but it's actually a company that's making real money out of this AI bubble. So, it's not, while there's a lot of circular stuff going on in the AI bubble and there's a lot of smokes and mirrors, Nvidia's making real money. It's kind of helping people take more debt to buy more of its stuff, and it's the picks and shovels trade. It will suffer when the AI capex bubble collapses, but it is a valid company right now, making significant amounts of money. What's been really phenomenal is over the last 15 months, we've seen Nvidia stock price increase by about 50%, add about 1.7 trillion in value. That's stats as of the end of last week, so it's probably paired a little bit yesterday. And yet, despite the fact that it's added more in market cap than almost every other company in the world beyond the 10 largest companies, it's actually fallen after almost every earnings in that period. So the last 5 earnings, on average, it's been lower a month later. On all of them, it's been lower 2 days later. In effect, 4 out of 5 is just consistently sold off for the month after earnings. So, Nvidia is normally a sell the fact event. It's a profit-taking event, but that's normally been within the bull market context. This time around, we've already got weakness, so maybe will it change the narrative? Maybe people have already taken profit. I don't know. I guess if I had to go for choice, I don't have high conviction. I expect Nvidia earnings to be very strong. I expect people to reaffirm faith in the overall AI bubble as more to inflate. It's not bursting yet, but I'm still not convinced that this pullback in markets is fully exhausted yet.
Okay, so plenty more to come on that front as well. I just want to ask you briefly, Mark, as well, what your view is on what's happening on Bitcoin. So we're looking at it back around the 90,000 level today, erasing all of the gains of the year. I mean, how do you view this?
Look, the important thing to remember is that Bitcoin is constructed to have a boom and bust cycle. It can never be stable at high prices because, the people who are Bitcoin fanatics, they don't even try to pretend it's a viable, got a use case. It's about hodling, and so you put it in a kind of way and store it, and that means hodling becomes much less attractive at much higher. When there's no volatility, when it stops going up, and it stops getting marginal buyers. The whole point is that people buy Bitcoin, they stack it, they hide it away. It's never used anything. You just guard your line in a spreadsheet and think about it and worship it and pray it and stuff, and then you hope you get another marginal buyer. But essentially, it keeps on needing more more marginal buyers all the time, and sometimes those marginal buyers run out, and they're more likely to run out when you get stability at high prices, because it stops attracting people. You know, why are you going to attract a greater fool when there's no kind of gains to offer? So it gets a boom and bust cycle. It can be stable at low prices, because when it crashes a lot, there's no reason for whales to cash out. But at high prices, when it starts losing volatility, it's always going to collapse again. See, I wrote a piece about 5 years ago saying that, you know, Bitcoin is always going to have another 70% correction. It doesn't mean it's the last one. It can always rise again in a world where we're destroying fiat currencies and we're going to monetize the big global debt bubble over time. I understand why people like things like crypto. They perceive it as a store of value. I'm not convinced, but I'm not saying it's crazy. It could have another cycle. But the point is, it will always have another 70% crash. And, you know, I said a few weeks ago, it looks like we're at the start of the next 70% crash. So, you know, I said at the start of November, I thought we're going to 40,000 in Bitcoin. Whether that's, you know, the last big crash and it goes again, I don't know. But that's always the case with Bitcoin. It is constructed for that kind of volatility.
Yeah, the Bitcoin roller coaster. Mark, thanks so much for being with us. Our Markets Live executive editor, Mark Cudmore. Stay with us. More from Bloomberg Daybreak Europe coming up after this.
Now, Britain's richest families are bracing themselves for the budget next week, overhauling how they manage their fortunes, taking more cash out of their businesses and moving to protect key assets. Joining us now to discuss, our ultra wealth reporter Ben Stopples. Ben, good morning. How are Britain's wealthiest preparing for what could be a host of potential tax increases next week?
It's interesting what we're seeing. We've seen one of Britain's richest families, for example, take out almost £1 billion dividend. Now, we don't know the ins and outs yet of what happened there, but it was broadly a restructuring of its shareholding structure. That was the Bamford family who owned JCB, one of our sort of biggest success stories on the manufacturing side. And other families are sort of reinforcing what I could say is their trust structures, and these are multi-generational, multi-billion pound fortunes. And broadly, it makes them feel, I would say, more robust, more battle prepared for what's going to lie ahead in just a few days for the next budget, where they could face indeed some higher tax rises. They're in better shape. Fighting fit is maybe the right way to put it.
I can imagine the Chancellor, maybe her team, saying that they aren't going to be asking people for money that they don't have. It's taxes on wealth that these individuals possess. What is their attitude, do you think, given your depth of reporting?
Yeah, it's a really good question, Caroline. I would say they're letting their money a lot of the time do the talking. A lot of them aren't doing talking publicly at the moment. If we continue with the Bamford family, one of the biggest fortunes we have on the Bloomberg Billionaires Index, more than $10 billion dollars or pounds, whichever you take it, they've just donated £200,000 reportedly to Reform. Now, that's the party, of course, led by Nigel Farage, that is absolutely hammering Labour, Keir Starmer's Labour Party in the polls. Now, they've got a lot of money, of course, a lot of wealth to tax, but it doesn't seem that they're entirely happy with it. And crucially, they're saying actually that the tax rises that are coming are going to damage the small businesses that are crucial to the broader operations of their own JCB. Now, I think that's interesting because their attitude clearly here is, Labour says they're all for growth, but actually JCB and the Bamford family are saying their attitude is that these tax rises could hit the very thing that Labour are wanting in order to get Britain out of its current economic volatility.
There was a lot of talk in the early days of the Labour government of wealthy families and individuals leaving the UK as well. I mean, what do we know about the scale of that now, sort of a year and a half into this government?
It's still a waiting game, Steve, and I'm sorry to keep you waiting there. We'll know officially on the actual official data for the first time, I think, in about August next year. Trust me, you can very much be the first person to speak to me when we know for sure. In the meantime, what we've kept reporting, as recently as last night, we reported that the head of, basically the top executive in London for the Qatar Royals family office has left the UK. He's been a long time here, Deutsche Bank veteran. He's left the UK for Italy, and he's from Italy. So what we're reporting is these individual cases here and there. And what I can say anecdotally from my own experience of doing this for almost 2 years now is a disproportionate number of Britain's ultra-wealthy individuals have left. Now, some people say there's no wealth exodus, but what I can certainly assert from my own experience is the multi-billionaires have often gone, and the sort of ripple effect through, I would say, Britain's billionaire economy, I would say, is going to be felt more sharply as a result of that, even if, let's say, only 10 multi-billionaires have gone. I think the proof, or the devil will be in the detail, as they say, as I'm sure they're going to say for the budget in a few days too.
Just very briefly, what is the most controversial tax increase when it comes to the wealthiest people in the UK? Because a lot of different taxes have been discussed, but what is the thing that's sort of most worrying those ultra wealthy?
A good question, Caroline. I would say for both the non-doms, former non-doms, the ultra wealthy individuals who hailed from abroad, who were living here, who've often gone, and for UK business owners, it comes down to one thing, and that's inheritance tax. At the last budget, in Rachel Reeves, at her first budget, Labour's first budget in more than a decade, it did catch business owners by surprise that she scrapped inheritance tax reliefs on business assets and agricultural property. And that was a big deal, and that's partly, I think, driving a lot of the changes we're seeing here, because they've got a bit of a window to do it. They've got until next April before the first reforms really kick in. So we actually saw in October 2024 the biggest, a massive jump in companies restructuring themselves. So the same month of the budget in anticipation of tax rises. And that's based on our analysis, 15 million company filings that we did for this piece. And on the non-DOMs as well, that's wealthy foreigners living in the UK, it was also a broad exposure to the UK's inheritance tax rates that forced many of them to up sticks and say, you know what, I want to live somewhere else. And the UK government is often saying, well, inheritance tax isn't such a big deal in terms of tax rises, but I would beg to differ there. It raises about £10 billion a year. We will, again, wait and see whether it's actually going to drive an increase in our tax receipts going forward.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.